We're going to go over what we're doing in this meeting and what to expect. That way we all have, basically you and I have an idea of what's going to happen. We're going to look at the company that we talked about. Basically you had 172,000 in a 401k with Fidelity, or 190,000, correct?
No, the first one was closer, and
172.
yeah, and that's
Okay.
based on the gyrations of the stock market, of course. So now, as far as a balance, it's about 164.
164. Okay.
Yeah.
Oh gosh, you keep losing money, don't you?
Well, in the long run, no. In the short run, yes.
Right.
You
So,
have to not look at your 401k. If you do, you go mad.
well, unless you have something that protects that money, which is kind of what we're looking at.
Right.
So what we're definitely with a 401k at a younger age, we are okay with the risk of losing money because they say it bounces back. But once I turned 48, I was like, well, wait a minute. Is there something better out there that you're not going to lose that money? That when the market goes down, it stays where it is, it doesn't go down. But when the market goes up, you're not having to make up from that loss. You're actually just gaining from where you are. And there
Right.
is, and that's what we're looking at, which is the FIA with a theme. So right now it's at 164. The reason that we decided to do this was because what was the biggest thing that you decided that you wanted to do this or thinking about doing it?
I didn't put too much stock in it. Um, as long as uh, the account stays relatively, speaking, where it is now, um, with 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 modest losses or with modest gains, we are happy. And as I say we, but I mean, Anne's not here. She is very camera shy, and she was adamant about saying no.
Tell everyone,
And
hello.
yes, in my 50 years of knowing her, I never forced her to do something she didn't want to do. So I'm flying solo. But
No worries.
we are of the same mindset. As long as it's stable, we're fine. And
Okay.
along with what we did on the insurance side to back up things, we are more than fine now.
Right, right. But I'm a little bit on a different side,
Yeah,
Charles, because I don't want to see your money lost for sure.
I
But I
understand.
actually want to see the growth. I
Right.
don't want to see it stable. We could put it in a CD, we could put it in a savings if we wanted to see it stable. I don't want to do that. I want to see you grow. I want to see you guys have money and be able to grow it. And that's kind of why I introduced this to you. So we're going to look at the company, see why we chose, because there's lots of different companies out there we could have gone with FIAs. Why do I choose, or did I choose in your case, a theme? We're going to open up an illustration and show you what you have the options to do. We're going to go through all the pages. We're going to play with the numbers because we can play with numbers. We can do all kinds of fun things with it. And then once we find something that makes you happy, puts a smile on your face, you don't have to worry about your wife slapping you when you get off the computer, then we have to submit an application for review. What that does is when we submit that request for the company to approve it, that just says, and we don't have to worry about health, which is a good thing. It's just the finances. It's me making you look good to the company so that they can roll that money over and they're not worried about your other assets. They're not worried about you becoming poor if you run this money into something else or roll it into something else and all that. So does all that
Okay.
make sense so far?
So far, so good. Yes.
All right. Along the way, if you have any questions, you can just ask.
Got it.
If I don't know an answer, which I can't say I know everything. I do have a big team behind me that I can get the answer. So the first thing I'm going to share is my screen. And what I'm going to show you is the company. Now, the company that I'm choosing for you based off of a couple of things is Athene. They've been around for quite many, many years. They've been at the AM Best, they're A+, S&P A+, Fitch A+, and Moody's A1. So they're very good. They've got the money to back what they're doing. It is an insurance product. What that means is they have to be able to back their money like a bank does, but it's not the same relationship as a bank has with FDIC. Okay.
Okay.
So in order for them to get this kind of rating, if the poop hit the fan, they have to give you your money like that day. right? Which
Right.
is even sometimes better than a bank. A bank, you have to sometimes make an appointment with, right?
And then
So,
stand in line.
right. So I logged in already to the illustration that I made. And the first thing I want to do is kind of show you what I did. I put your information in here. I put the wrong state, but that doesn't matter. Let me just switch the state. You're in New Jersey. Now, the tax qualification of this money, I believe, and I'm gonna just kind of make sure by this. I believe you said it's in a 401k with
Yes.
Fidelity. Okay,
Yes.
stocks and bonds, stuff like that,
More. Yeah. Yes. A
where
mix
you
of both.
pay taxes at the end, correct?
Yes.
Okay, downside to a qualified account is that you pay taxes on the end. Because right now, sure, you're 73, but when you take this money out, you're paying on those taxes then. Could be higher than if you paid them in the beginning, right?
Right. Yes.
Downside. But people do it, and companies will give you that money, and they'll sometimes match it and so on and so forth. Policy details. We have two options here. What is a withdrawal charge? Let's talk about that. You have a 7-year withdrawal charge period. And if you look on the right, it changes the numbers. And you have a 10-year withdrawal charge period. I'm going to show you what that withdrawal charge means. But in short, just right now, real quickly, is you're committing to not withdrawing the full amount in the first 7 or 10 years. Can you still take money out? Yes, there's the 10% that you're used to. There's the RMD, which you need to take. And then there's the bonus that you're going to get. You can take from that. But if you withdraw the full amount, you're going to have a withdrawal charge. So how long, what are the positives and negatives of 7-year versus 10-year, right? We'll look at that. As far as the amount goes, I'm going to change that because you said it's 164 now.
Yes.
Okay, so I'll change that to 164. Right now we're illustrated at the hypothetical historical assumed rate, which is 7.0. It could go higher, up to 15%, and it could go lower, but you're not going to have any loss. Right now you're starting it at 7%. No losses to that ever. So you're never going to have to make up money with this type of thing. You'll never lose that base premium.
Okay.
Unless you withdraw the full amount before that 7 or 10 years. Okay. Keep that in mind.
Got it.
Strategies. Now I could go into all kinds of crazy things, but I'm going to keep this very simple because if I go into crazy things, even I confuse myself. There are reasons why you'd want to do strategies with charges. One of them would be you're younger, you have a little more, you're willing to lose less, gain less money, I should say, gain less money. You have a charge and it charges you every single year. Yes, there's the high chance that you're going to gain more money with a charge. So we can play with the numbers if you want to, but someone who's over the age of, say, 55, and they're really wanting to use that money in the future, I typically tend to stay with the no charge. So this is what I do. This is with mine. I have a couple that I did charge, but I had done them earlier when I was younger. And then I have, if I do any, it's really just rolling my money with no charge. I don't want to pay anybody to watch my money. I don't want to pay anybody to lose my money. They don't lose my money, but to not gain it, right? Like I don't want to play the market like that. So what I did for yours, and we can play with these numbers as well. I put 50% of it in the BNP Paribas, which is doing very, very well. And then the S&P 50%. Now, when we play with the money, the numbers, what we can do, I've got to move you over here, is we can play with how much do you want fixed versus how much, and you can do a percentage of that. You can do 10% and, do, say 40, right? And it just changes these numbers a little bit. However, you have to remember an illustration is just an illustration.
Right.
So I think of an illustration as like, you have grandkids, right?
Huh?
Do you have grandkids?
No, bite your tongue. No, I'm only
I
kidding. No,
want,
don't
I
have any.
want grandkids. Okay, think of a child and they draw you a picture and they draw it with a pencil. It's called an illustration, right?
Yes.
But if they take a red crayon because the market changed, right? The market changed. Now we're coloring the illustration. It changed the illustration.
Yep.
That's exactly what this is. It's just a picture of what it looks like. Okay. So I'm
Makes
going to
sense.
show you, I'm going to show you the illustration. We're going to go through it. And I might have to switch sharing screens. It might pop up and you might not see it. So hold on. Do you see a swimmer?
Yes.
Okay, this is your illustration based off of how we just finished it. So we finished it with the 10% fixed, 40% S&P, 50% Barnabas. Okay,
Got it.
that's what we did. And we did it with the 164. So basically this company says this is called a single premium fixed index deferred annuity. It's a long-term retirement savings product, protects you from outliving your money. You want to make sure you have money for the rest of your lives, including your wives, right?
Mm-hmm.
You will get a copy of whichever one we decide to settle on and submit. This is a hypothetical illustration, okay? It will predict what happens in the future based off of the last 10 years of what the market's done moving forward. So it'll take the last 10 years and it'll move it forward, and those are the numbers you're going to see. There is a guaranteed part, which means, let's say that doesn't happen, the market drops for the next 3 years and you don't have any gains at all, right? Because that's not going to happen. I mean, we'd be in worse trouble if that did happen than worrying about an illustration. We'd be in deep trouble if the market dropped for 3 years in a row.
Oh, yes.
Right. But
Carnage everywhere.
right. But the hypothetical part, the assumed part, that's what it's probably going to look like. There's going to be years where the market doesn't go down. I mean, doesn't go up, but it's not as many as all of them.
Got
So
it. Okay.
some of the words here, the guaranteed, I just talked to you about the growth potential. This has higher growth potential than what it's in right now because there's never a loss. You also will receive a premium bonus. We'll talk about that. That means the money that you're putting into it today or whatever day it starts will gain a bonus right off the top. The reason why the company does that is because they're helping to defer any taxes that you need to pay. It is a rollover, so you're not paying those taxes as if you were taking it out. But any fees that your company is going to charge you, that premium is going to more than pay for, the premium bonus is going to more than pay for anything negative that goes into that account. Okay. And then, of course, the protection from an FIA is huge because there's no downside market risk, which is huge. It's the same tax deferral that yours is already in, so you're paying the taxes in the future, unless you don't ever withdraw the money, right? If you never just withdraw the money, you're not paying those taxes, but somebody will eventually, right?
Eventually, yes. Mm-hmm.
And then you can use it for a stream of income later on. You can turn that on at any time of your life. You can say, I want income from it. And then of course, one of the difference is this annuity has basically your family, I would assume Tamaki is going to get this as a death benefit. And it's not going to be put through probate. There's no capital gains tax. She's going to get this money straight up. It's a death benefit.
Okay.
Because it's with an insurance company.
Mm-hmm. I got you.
So, all right. Any questions so far before I go on?
I'm still with you. Yes.
Awesome. All right. So we put the information in, we put it as qualified money, 164. These are the no charge allocations. These are going to be changed at any time after a year. You can change those. Okay. And all the fees, if there are any, it's basically the rider charges, it's 0.95%. You're not going to even see that because you're getting an 18% premium bonus because of your state. So every state's different, but New Jersey allows for them to give you 18% if you keep it in for that 10 years. Okay. And when I say keep it in, don't be confused. You can keep it past that time. You don't have to move it, but you can't withdraw all of it in that 10 years.
Right.
Make
Gotcha.
sense?
Makes sense. Yes.
Okay. However, that bonus is available day one. So as soon as you roll that money over, it also adds that bonus day one, and that's usable. Okay.
Okay.
So this is just telling you about the different, I don't go much into detail on this because I'm not going to lie, I don't really care about this stuff. And I put you in the best ones that are producing the best at the time. And from what I've been told, it's the BNP and it's the S&P right now. So that's
Right.
why I did
Understand. No
mostly in
worries.
there.
I got you.
The next one I want to show you is when you get this in your email, you're going to see that this is guaranteed. These are the market does crappy, your money doesn't grow. That's it. Market's doing crappy 10 years in a row, money's not growing. This is
Right.
the base bottom. You're never losing your money, ever. And it's growing very, very slowly, but you're also using it because you got to take money out, right? You got to take
Right.
that RMD. So this is not the one we really look at, but it's there for you to see if it were to happen. Okay. And it would happen where it is anyways. It would be the same situation if it was in the Fidelity. All right, then we move to, see, as you can say, historical performance. Then we move to the actual non-guaranteed. This is the most recent 10-year period move forward. What's it going to look like if we did the same as we did in the last 10 years? Okay. So taking your RMD, because you have to, right? Sorry, I can't just highlight that for some reason. The first year you have to take 7,300. And a lot of my clients, what they do with that 7,300 is they'll put it into something else, right? Maybe you need it to live on. That's fine. But maybe you just take that and invest that into an insurance policy or into another, a CD until it's big enough for an FIA, right?
Got it. Okay.
You can do stuff like that. But you're accumulating the withdrawals. So over, let's say 73 to 83, you've taken out almost $100,000 and you still have $173,000 as a death benefit because you're taking out, right?
Yeah.
So you're kind of taking out because you have to, but you're also growing and it's all adding up,
Okay. Question now.
Yes. This is where I might need help.
Yeah. No worries. No worries. Say that's the RMD withdrawals you're talking about.
Yes.
So if it turns out that it is not needed, instead of being greedy, could we just roll it back over into the death benefits there?
Yeah, if you don't need to take an RMD and they don't make you don't have to do anything. Just leave it there.
Okay, good.
Yep, absolutely good question. All right, so that's how it looks by the time you're 95, because you're going to live to 120, so I can pay for your funeral because that's what I promised you.
Suppose I don't want to hang around to 120. Jesus.
Even for me to pay for your funeral? Come on now. You can make this do a lot, and this is based off of, even if you were just to live on that money or leave that money for your family, we would take this money and put it into something if you can't put it back in here or leave it here. That's what I would suggest.
Understand.
All right, so those are non-guaranteed values. Now I want to play with some numbers here. This stuff is all like, this is like me reading Spanish. Like, I don't know how to do it. Just kidding. I know how to do it. I just don't like to. Let's see. This is all about the different strategy types, free withdrawals. Okay, something important to know is that whether you want to use the money or not, you have the ability to. And just like your 401, because you're 59 and a half, you're over that by just a little bit, but you are. That you can take that 10% if you wanted to. It's free. You don't have to worry about withdrawal charges, nothing like that. You can actually even take from the bonus that they give you day one. So if they're giving you an 18% bonus, you can borrow that, or not borrow, you can actually take it. You don't have to pay it back and do whatever you want. Maybe you want to take, I don't know, maybe you want to take Tamaki on a cruise.
No, no, no
But
cruise.
let's say you did, you can actually take that bonus and utilize it. Maybe you need a new roof, maybe you need a new car, whatever it is, you can utilize that bonus free. You don't lose anything because of that day one. Okay. You can
Got it.
also take 10% of the accumulated value on the contract anniversary after the first contract year. So, and then it accumulates. So if you don't take any money, it just keeps accumulating and you can take more and more and more and more if you want. Okay. I know you
Right.
don't want to take the money, but if you want to, it's there. Or if you
Got it.
need to, it's there. Right.
Understand.
Other than that, these are just the words that, this is a nice dictionary. And I don't really look further into this, but what I do want to look at is the next step. Playing with the numbers. This is the fun part. That's not what I meant to do. Hold on. Technology is not my thing, Charles.
No.
All right. Here we get to play with the numbers. Okay.
Okay.
What we can't change is we can't change how much you're putting in. Right?
Right.
I'm sorry, I'm lying. We can change that. I'm sorry.
How
Well,
so?
we can't change where it's coming from. So we know I can't click this. Probably because you guys are there. I can't click this word client, and I think it's because something is there blocking it. But we
Yeah.
know that you're a male. We know that your name is Charles, and we know that you're 73, I believe, right? So we can't
Yes.
change that. We can't change where it's coming from either. It's coming from your Fidelity, and it's coming from what's a 401k, which is a qualified account.
Okay.
And that means you're paying the taxes on it at the end. Okay. So we can't change that.
Got
What
it.
we can change is how long you want the withdrawal period. We can also change how much you're rolling over. So maybe you're like, I don't trust Heather. I'm only going to do $100,000. Bam. That changes things,
Of
right?
course. Yeah.
Maybe you say, I lied to Heather. I have 200,000 I want put in. You're like, Heather, would somebody really do that? Yeah, they do it all the time.
Really?
Yes, because they're afraid. They think that, that if they divulge too much information, that I'm out to hurt them, right? They don't know me as well, or they don't know me, and I don't know you well either, but there's people out there who would do that. Let's just put it that way.
Okay.
So this is changeable, right? We also can change how long the charge period is, and we can also change, we can't change anything here. It is what it is. And we can change who allocates the premiums. I mean, the premiums. We could do a strategy preset, and we could do growth, conservative, balance. We can do whatever we want here. In your case, here's what I'm telling you. The strategy preset is 100% towards that. That means they do it, we don't touch it. I prefer, and I'll tell you why, because I like a little hands-on for my clients. You might say, Heather, I want nothing to do with it. If that's the case, we'll leave it at strategy preset. We'll look for growth or balanced or conservative, whichever one you want.
Okay. The manual allocation.
That would be us designing it.
Of us, me and you, or us
That's
being
right.
a team?
No. Manual takes them out of the picture.
And it's you and me doing it.
Correct.
Okay,
And
gotcha.
now every single year you will get something in the mail and I've gotten it many years in a row here, that says, okay, it's time for you to reallocate your funds. Do you want to keep it the way it is, or do you want to reallocate? So I look and I see what's going on. I'm not a financial advisor who watches the stock market on a daily basis. What I do have is a huge team of people that I can reach out to and say, hey, what funds are doing well? Should I allocate for the next year?
Right.
That's what I have,
But
right?
if we go with the growth route,
Yep.
would
It does it
automatically
all by
take that.
itself. It
Yes.
does it all by itself. And
Okay.
I think that might be a good thing for you, honestly,
Yeah.
right? Because then we know that that's always going to be growing. It's going to be growing to those. Now, what that comes with is it may come with a bunch of charges,
Well,
right?
of course.
Right? Because somebody else is doing the job for us.
Yeah.
Makes sense? So we
It's
can,
only natural. Yeah.
right. So we can certainly do that. And if you look at that, let's change, we can play this game. Let's put it back down. What'd you say it was? 164?
Yes.
Are you lying to me? No, I'm just kidding.
Oh.
Um, look at the difference and what it can do. Now, remember, this is just an illustration, right?
Right.
So you've got you started it with 164, we're in value number one, which is year number one. You
Mm-hmm.
put the money, you roll the money in, and now they give you an 18% bonus, and your death benefit, if you died tomorrow, which you're not going to, Charles, but if you did, right off the top, your family's getting 192,348. You just gained a lot of money.
A lot. Yeah. That's too big for my basic math. Let's just say it's a lot.
I almost tried to do the math. It wasn't working for me. I wasn't mathing. But now let's watch that number, right? And you can even take a picture, okay? So, because I'm not good at remembering things. That is with 10-year, 164 strategy preset growth. Let's see if we change it to balanced, what happens? 192,348. So it only takes it down just a little bit, right? It takes a couple $100 off.
Right.
Now let's change it to conservative. What does it do? Whoa. That actually gave it more.
Yeah. It's went
That's
up.
interesting. Yeah, it went up by a lot.
I conservative. Hmm.
Interesting.
I was
And what
expected to
that
be just the opposite. With
I
growth
thought it
went
was
higher.
too. I thought it was too. But I think what happened here, if you take a look, now that I'm looking at it, because I'm understanding this.
I know. Since it's not a growth, we're not paying charges. Ergo,
That's right. 100%. So you're allocating it all into these not assets, but these allocations, and there's no charges. So now you just gain you gain $7,000 of not having somebody else do it.
right. But
That's a
wait a minute.
lot.
Go back to that slide that says the growth versus, but it's still under strategy, right?
Yeah, this is all strategy preset. That means you're telling them, yes, yes. Good question.
if it's growth, then I'm paying someone to do it. But if
They're
it's
well, not necessarily. It's just a with charge. That means that they're charging you for
yeah,
putting it
yeah.
into this fund. Yeah.
But if it stays conservative, then they
They're
are not
still doing
charging.
it. They're still doing it, just no charges.
Got it. Okay, gotcha.
Correct. And honestly, that one looks better to me
Then growth.
than growth. So I would almost keep it there. Now, here's the other question. Look at the 10-year versus 7-year. You're 74. Do you plan on taking this? Do you plan on taking any more than plan on? That's a key word there, right? Do you plan on taking any more than what the 10% is, or the RMD or the bonus? Are you planning on taking more out within the first 7 to 10 years?
No.
Okay, so let's look at the growth amount in 10 years. Okay, compared to if we keep the withdrawal charge period at 10 versus 7. Okay. And I say 10 years because I want to see the difference. I don't actually know. I'm taking a picture so we can compare. 249, 182.
Right.
Oh, no. I lied.
Yeah, I gotta change that.
299. So it's almost better.
Well, shouldn't you change the 10 to a 7 on the right-hand corner? There's a summary value, right? You go up one box. Yeah. Shouldn't it be
Well,
7 if this
hold
is
on.
7 here?
No, because I was comparing 10 years out.
Oh, okay.
So 7-year withdrawal period, 299 after 10 years, 10-year withdrawal period, let me move it back to 10. 249. So I would keep it at 7 year.
Seven would be the better option. Yeah.
Yep, and and then 7 year, first year bonus is 182, and 10 year would be 199. So you're getting a bigger bonus up front, but the 7 year is best long run. And you don't need a bigger bonus up front because you're not looking to take that money out. So we're looking long term.
Yes.
So I would tend to want to go back to this. If you were thinking of taking some of this money out and using it to start a business or something like that, then I would do the opposite. So I would personally recommend 7 year conservative, because we know we did the math, we saw that,
Yes.
and leave it like this.
Yes.
And then the death benefit's just gonna go up. Let's just say you died at your 74, so 84, 94. So this is just gonna keep going up and up, even with you utilizing money from
Yes.
your withdrawals, okay? Never gonna lose money. That was a big sigh.
No, numbers, numbers are like, they're outstanding and stuff.
Isn't that crazy?
Yeah, but it's, you know,
I'm
it really is a big step, because you're leaving something that you're comfortable with, going to something that has great promise. So anyway,
yeah. And I guess that is one of the reasons why this number is flexible,
yes,
right? If you're comfortable with where you're at and you want to only take 100,000, we know the strategy's good, right? We know the withdrawal period's good. We know everything's the way you need it to be. What if you did just part of what you were doing? Or, you can do whatever you want. This is the number that can change, right?
got it.
You
Got it.
change that. The only issue that you would have would be this doesn't lose money, whereas your other one can lose money, and it will, because it's the stock market, right?
Yes.
It's proven. And this, when it gains money, gains from where you're at, not the loss. Whereas the stock market money would gain from the loss, right? So you can do something like that. You can do a little bit of 10 baby steps. I'm going to be 100% honest with you, as I always am. I did that.
You did what?
I did baby steps.
Oh, okay. All right.
And I'm going to tell you
Cool.
my story. I know.
Okay.
It was, I regret it now, but it's okay. It's okay.
Yeah.
Like things happen for a reason.
Yes.
My husband, my second husband, he died when I was 38. And he left me with, he worked at a company called, Pratt and Whitney out of
Yes.
Connecticut.
Mhm.
All right. So he was an airplane engineer, engine thing. He made things inside engines. He had a huge pension, because that was back in the days when they had pensions.
Yes.
And he had this huge 401k because he was old. I wasn't, he was. He'll laugh in heaven, me saying that.
Mhm.
And he left it to me, and I was clueless with money at the time. Totally clueless. I had no idea who our mortgage company was. That's why I'm very adamant about protecting your family and making sure your wife is good to go. Okay.
Oh, yes. Oh, yes.
So what I did at that point was I had a financial advisor, because when Bill died, this guy was apparently our insurance agent, and he was a financial advisor. I didn't know anything, so I trusted him, and he's not a bad guy. So don't think that I'm saying that he's bad in any way, shape, or form. He's not. His name was Mike. He was from Prudential.
Mhm.
There's a long story behind that. He put all of my money into an inherited IRA, which, to his defense, that's all he knew, because he didn't have this type of product.
Right.
He wasn't eligible to even think about this product. He didn't tell me about this product, and I didn't do insurance at the time. I was a teacher. So I trusted him, put all my money in. Well, I got licensed. I heard about these products, and I started thinking, because I think a lot. I don't know if it's because I'm a woman or it's just because of who I am, but I think a lot. And I thought, you're talking about this stuff with your clients. Why can't you do this with your money? Now, keep in mind, I had inherited about $600,000 that
Right.
I didn't feel was even my money, because this was his work. It was my second husband. It wasn't even my money. It was my kids' money, right? Mike had put it into an IRA and it grew to almost $1 million. It was at 900,000.
Okay.
And then the market dropped and it kept dropping and kept dropping and kept dropping. Mike, what's going on? What should I do? He's like, just let it ride out. Let's just let it ride out. When did it drop last? 2020, 2021?
Somewhere around there.
Yeah. Whenever it started dropping, I waited, and then I became smart about this stuff. And then I waited more and I waited more. And then I said, Heather, you're not waiting anymore, because I had lost $300,000. Every gain that I had from him was gone. So I'm thinking, and I had to pay him 1%, right? He was taking 1% of money a year, 1% of that money per year, just to
Just
gain
to watch it evaporate.
right? And I'm like, if I had this money, if I had that 600,000 in a product like this, and it gained the 300,000, I would have had 900,000, and it wouldn't have dropped. And even if I had 800,000, because I didn't earn, whatever percentage over 15%, right? Because this only goes to 15%, just so you know.
Right.
But if I hadn't gained, I still would have gained 200,000 versus losing 3 and not really gaining any. What was not smart was I decided to start moving stuff over little by little. And it was more of a heart thing, where I had a relationship with this Mike, not a relationship, but a financial relationship with this Mike. And I didn't want to hurt his feelings. I'm not kidding you. I was like,
it's not hurting feelings when you're talking about your financial.
Oh, but he helped me so much through the death of my husband.
I understand that, but it's easy for me.
I know.
But that's a
so,
good point.
So what I did was I moved 250,000 over to start. That was my first jump. And I was like, and I got the bonus, and it was only 15, because whatever I think I was in, I don't know, whatever state it wasn't, or the bonus wasn't there that high at that point. I think that's what it was. It was only 15% bonus at the time. Now it's up to 18, depending on what state you're in. So I got the 15% bonus. I utilized that for my company. It helped my company. I was able to grab that money out, use it right away, right? I saw how beneficial it was. So I then moved another 50,000. Then I moved another 200,000 or something like that. I eventually moved it all out. I'm on my final chunk of money right now, rolling it into this from my new husband. I've been married to him for 3 years. He's the one that's the retired Navy chief. His 401k that we rolled into Prudential, we are now rolling that into this account.
Question now is, when you have a client and they decide to go with you and a thing, and a thing talks to, in this case, Fidelity, and say, roll over Charles Sanders's funds to a thing. What's the pushback from Fidelity? Are they saying, "Wait, what's going on here"?
There's none. There's none. So how the process works here, that's really good question. They don't have any, even Mike, even when I transferred my own money from Mike, it was more of a personal thing, because Mike, I had like this vested interest in, right? The company has no hold on your money. They're not allowed to legally. They don't hate you. They don't put death claims on you. They don't, nothing of that. What happens is you actually put in an application. So you'll put in an application straight from here. You and I will get back on Zoom, and we don't even have to get on Zoom. I have everything. The only thing I'll have to know is your account number from Fidelity. We can choose for some companies, Fidelity. How do they do it? Bonnie just did Fidelity. So with Fidelity, what they make you do is request the funds Yes, this is how I just did it with Bonnie. We requested the funds. We had to call Fidelity, get on the phone with them. I can't do it without you. They have to
Yes,
have you on the phone.
yes.
They're gonna send you a check. Now, it's not gonna be made out to you, because if it's made out to you, then you're liable for taxes, right? They have to make it out to Athene. You receive the check, you overnight the check. I pay you for the overnight charges, because it's a service that I do. I don't want I don't want you to pay any more money than you should. So I send you the overnight fee. Once you send the check, just send me a picture of your receipt. That receipt gets, I mean, that check gets delivered to Athene, and the funds are transferred automatically. No taxes paid
Okay.
once you pass suitability.
Fidelity did it. Yeah, she didn't have to take it.
No, she had to pay a separate check.
Not on the 6th. So she guaranteed.
Any other questions? Did that answer your question?
Oh yeah, it did. Yeah, it did. I just
Okay.
I'm starting
So
to
it was
think
very
process.
simple. It was very simple. Let's put it that way.
Sometimes the simplest things are the best things, and the bonus, when they transfer the 164,000 over and get that 18% bonus, it jumps up to 182 or whatever it was, and I can still, well, we can still pinch off of it when need be.
Yes. Yes.
But with my pension from the Air Force and the um, Social Security, yeah,
yeah.
our Social Security, we should be okay. But the price is going up now. We got my what the hell did we just do? A hundred,
Right. So
180 dollars.
if you want to take 10%, you can. It's there. Because you just gained 18%.
How about less than 10%?
Of course, you can take
Okay,
whatever you want.
good.
Any of this that you want emailed to you, do you want the illustration emailed to you?
Yes. If it's not too much of a bother, yes.
It's never a bother for you, my dear. And then the only other thing I want to say about it is all the numbers are adjustable,
Hmm.
and it can get confusing. So if you see something that you're like freaked out by, understand if we didn't go over it, it's probably that you're misreading it. A lot of the times it's the guaranteed part. People are like, there's got to be a guarantee, because if you don't have a guarantee, then you're in something like a 401k. They don't have
Right.
guarantees. This is guaranteeing you're not losing your money in any way, shape, or form. However, you're likely going to do better than that. So
yeah.
I will email you that, and then you and I will text, because you're good at texting. If you want to move forward with trying to see if they'll allow you and permit you to actually transfer your money. What's today? Wednesday? Thursday? Let me know either way, but what, Saturday? Do you think that's enough time for
That's
you?
more than enough time, yes.
Okay, all right. Let me know by then, because I do have to do some things on my end to save that and get the application started. And we can do the application on Zoom, or we can just do it over the phone, or I can fill it out and just send it to you for signatures. I already have all your information from the insurance.
Okay.
Thanks for letting my team be a part of this. That was probably the best training they'll ever get.
Did they take notes?
Hopefully they did. Hopefully
Yeah.
they did.
When you retire, you being me, um, I wasn't expecting all of these monumental decisions, but here we are. And I
I
can't.
mean, I'm gonna dumb it down for you, because in my own personal way, um, it's your money and it's the same money that you have. It just has more of an impact on positivity in this sense. Your money's gonna be your money where it is right now. This gives you a bump and a bonus in the future.
Right.
There's no losses to your money in any way, shape, or form. That's
And
key.
if you manage it correctly, it can only enhance your standing financial wise and stuff. So.
Correct. Right.
It's a thing, right?
Athene is the company, yeah.
Okay. So if I wanted to read up on a theme and see how they got started and what their business practices is there a website I could go
Yes.
to?
Athene.com.
I should have known. Athene.com. Got it.
Yes. Yes.
I should write that down too.
Well, I'll send it to you in the email. How about
Okay,
that?
good. Good. I want anything that I'll save my ink.
Yes. Let me just read what it says. See if
Okay.
it says anything good or bad. They're never going to say anything bad about themselves. Come on now. Every company is going to have good and bad things. Fidelity has bad things. There's enough people out there, and Athene probably have bad things. I don't know. But, you know, it's like even with Family First Life, our brokerage, people will say bad things about everything.
Mm-hmm.
Even if I go to a restaurant, which I do Google reviews all the time, I tend to only review if it's really, really, if it's bad or if it's really, really good.
Mm-hmm.
Right? Those are the two times that I'll do a Google review. So if it's bad, I'm more apt to comment that it's bad, right? If it's good, it's got to be dang good for me to comment because it takes time. It takes time for me to put my review in. So the fact that they're A+ rated in all the markets and everything it's a good sign. The fact that your insurance agent has all 3 or 4 of her, plus she's moving more into it, that's a good sign. No, I couldn't have made that up. I showed you live.
Yeah.
Right? So those are good signs for the company. The reason I chose Athene over a couple other ones is because they gave you the biggest bonus. So they're offering you 18%. For me, it doesn't matter. The only thing, I don't get paid a lot on these rollovers. I'm not going to lie to you. I get paid more on the insurance than I do on these rollovers. However, it's not just about being paid. As you can see, maybe you can't see. All of my company, my agency is called FFL Just Serve. There's my Just Serve logo right there. I aim to serve people, especially veterans, but I'll serve people who aren't veterans. Just God bless them a little bit more. No, just kidding. I aim to serve. And if I did that wrong, if I served people wrong and then found out I did it wrong, I certainly wouldn't do it intentionally. But if I found out I do it wrong, I don't know if I could live with myself. So what I do and what I say and what I attempt to do is just for the best of the person. I had my team come on because I knew it would help them. I asked you first because I knew it was the appropriate thing to do, right? Like you have to do what's best for people if you can.
Yeah.
You know?
There's this do yourself, not do yourself, but on HGTV, how all these shows about fixing houses and stuff.
Yeah.
Mike Holmes. Is it Mike Holmes? Anyway, yeah, home. It's home something. And his logo is make it better. So if you mess up somebody, you make it better, right?
Yeah, I try not to. I don't know. I definitely would always fix it if I, you know, if I did
know, I'm
something
kidding
wrong.
you, but
Holy smoke. No, I would.
yeah, make it better.
Yeah.
Oh my goodness.
All right, so I will talk to you before Saturday and we will, once you, and if Tamaki has any questions, please just text me. You know where I am, okay? I'm gonna stop the
Yes.
recording.
I tell you what, I am definitely